about to drop the hammer and dispense some indiscriminate justice.
Alright everybody, welcome back to Strongman Personal Finance. I am Christopher Bell, certified public accountant, long-term boglehead investor, author of the book Stop Being a Broke Loser. It's on Amazon for $3. I know, it's a ripoff. And hater of stupid portfolios that make absolutely no sense. Now today, we're going to talk about Ray Dalio and his all-weather portfolio that is supposedly supposed to be good for every economic environment. If that's the case, that's fine, whatever. What I'm going to talk about in this video is how I think, or why I think the underlying investments make no freaking sense to me. And the vast majority of what he's telling you to put your money into for this all-weather portfolio is ridiculous. Now, like I said, the all-weather portfolio is supposed to be good in every single market environment. And it's supposed to minimize volatility, so you don't freak out and sell your investments, and whatever. Let me tell you what, if you want to build long-term wealth, you need to be able to deal with volatility, okay? Everybody says everybody has a different risk tolerance, but in the long run, if you want to grow your wealth significantly, you're going to have a heavy equity allocation, aka stock allocation, to your portfolio when you're younger, and then you can transition that over to bonds as you get older. I don't care if you don't like market fluctuations. You're going to have to deal with it because that is the only way you're going to build enough wealth to retire, okay? I don't care if you get freaked out. Don't look at your portfolio. But if you just have to have a portfolio that doesn't have any volatility, even though you may sacrifice hundreds of thousands of dollars, then I guess you could do the all-weather portfolio. So this is Ray Dalio. He's the founder, co-chairman, co-chief investment officer of Bridgewater Associates. So I think it's probably one of the world's largest hedge funds. I mean, whatever. That's cool. He's a billionaire, so a lot of people just take his advice without questioning it. But I think you should always do your own research and not take anybody at face value, even me, even though I'm probably right. Now, let's go look at the all-weather portfolio, and I'm going to explain to you bit by bit why I think it's complete trash. So the all-weather portfolio is the product of Ray Dalio. And it's been shilled by Tony Robbins. Now, if you don't know who Tony Robbins is, if I'm thinking it's the correct guy, he's that guy that, he's got this like scam course and he charges people like $5,000 and they fly in and he dances and he pumps them up and tells them whatever he needs to tell them and he just takes their money. That's Tony Robbins. I think he's kind of a scumbag. And I think he's a weirdo. And he almost gives me like culty vibes. But anyway, so Ray Dalio and Tony Robbins are probably the biggest shills of this all-weather portfolio. And it's supposed to basically minimize, volatility and the risk and all that crap. But I think in the long run, if you invest in this portfolio right now, you're going to have pretty significant underperformance. So let's look at the portfolio's makeup, and I'm going to freaking tear this apart because I think this is horribly bad. This is garbage. This makes no sense to me. Now, excuse me, let's look at the asset allocation. So Ray Dalio says, for the all-weather, I'm dying here, Jesus. I'm not editing that out. I don't like editing. So Ray Dalio says you should have 30% stocks, 40% long-term treasuries, 15% intermediate-term treasuries, 7.5% commodities diversified, so lumber, rocks, chicken crap, whatever, and 7.5% gold. Now, let's go piece by piece. The first part that I thought was stupid in this portfolio is he tells you to have 30% stocks. Whatever. I mean, if you're super conservative and you're old, maybe that's reasonable. But why only U.S. stocks? Now, I've said this 1,000 times. U.S. stocks and international stocks go in cycles. You don't want to put all your portfolio in one country. So just the fact that he's saying 30% U.S. stocks and nothing international just tells me he has a massive home bias and he has a recency bias because he's only looking at recent outperformance of the U.S. stock market. So I think that's stupid. 30% stocks. If you want 30% stocks, you might as well have VT, which is the Total World Stock Market Index ETF that owns every company in the world at market cap weights. International will outperform the U.S. one day. I guarantee it. I don't know when, but it will. And that's why you need international. You can't just be 100% U.S. stocks. And you may look back and be like, well, the last 10 years, I don't care. I don't care, okay? Look back 30, 40, 50, 60 years, and then think logically. Is the U.S. always going to outperform? Always? There's not going to be other economies that are going to emerge and potentially take over the United States? That's up to you to decide, but if you just have to have U.S. stocks, you go right ahead. But this is the first thing I don't like about this portfolio. The next thing, he wants you to have 40% long-term treasuries. Those are long-term government bonds, and 15% intermediate-term treasuries. Those are intermediate-term bonds. So I think to be classified as a long-term bond, it needs to be like 20 years or more. And then an intermediate-term bond, I think, is like between, I don't know, 2 and 15 or 20 years, something like that. Don't quote me. But basically, think about it this way. Whenever you buy a long-term bond, the value of that bond is the present value of all the future cash flows at the market interest rate. So, for example, if you buy a bunch of treasuries right now, we have historically low interest rates. So right now, you're going to be getting, I don't know what, 1%, 2%, maybe 3% per year for long-term treasuries, and you're going to get less for intermediate-term treasuries. Now, if interest rates go up, which I think is a possibility at some time in the future because we're printing off massive amounts of money and our government is incurring more and more debt, there's always that possibility, or inflation could result in interest rates going up. The present value of all those future cash flows means that the bonds are going to have to go down in price. Now, look recently at what happened to long-term treasuries and intermediate-term treasuries when we had that brief spike in interest rates. They got freaking hammered because long and intermediate-term bonds are very sensitive to changes in interest rates. So if we see a 1, 2, 3% increase in interest rates, that part of your portfolio is going to get freaking annihilated, okay? This is way too concentrated in long-term bonds, especially in such a low interest rate environment. Because interest rates can't go much lower, but they sure can go a lot higher potentially. And if you're holding a high percentage of your portfolio in long-term treasuries, you're going to get freaking hammered, okay? So yeah, 30% US only stocks, 55% long-term treasuries, or intermediate-term and long-term treasuries during historically low interest rate environment. And just to top it all off, he wants you to have 7.5% in commodities, which produce no cash flows, and 7.5% gold. Now, I hammer this all the time. When you buy an investment, you can only classify it as an investment if it produces cash flows. If it doesn't produce cash flows, goods or services, if it's just an item like this pin here, this is not an investment, okay? This is an inherently speculative thing. Now, a commodity, the only way you can make money from a commodity, if you buy, let's say, a block or what do you call a compilation of lumber? Let's just call it a block of lumber. A big thing of lumber. And you're hoping that you can make money off it. The only way you can make money off that lumber is by holding it and then hoping that somebody buys it from you at a higher price. There's no cash flows involved. The lumber is just lumber. It just freaking sits there, okay? Same thing with gold. Sure, it has some utility, but a piece of gold now is going to be a piece of gold 1,000 years from now. It's not going to compound and replicate itself, unlike a company which produces profits, can reinvest those profits, and achieve compound growth. That's the difference between stocks and, even bonds. Those are investments too. And commodities, where you just have one thing and it doesn't change, and the only way you make money is by selling it at a higher price. So he wants 15% of your portfolio in an investment that is basically the greater fool theory, hoping that somebody buys whatever you're investing in at a higher price. So overall, I think this portfolio is just complete and utter trash. I don't like anything about it, okay? If you're so worried about fluctuations in your portfolio, well, too freaking bad, okay? That's the part of investing that you need to learn and to be able to deal with. Because if you want to actually retire, you can't have all your money in like these ridiculous investments that could probably screw you over. 30% US stocks, come on, what, international? 55% long-term treasuries during historically low interest rates, that could significantly go down in value if interest rates go up. And commodities and gold, greater fool theory. Horrible. Garbage. Anyway, that's it. I don't like this portfolio. I like Total World Stock Market Index funds, or ETFs. And then if you're worried about, the market crashing, you can have maybe a little bit of allocation into short-term bonds. But, you don't have to believe me. You can trust Ray Dalio. He has more money than me, so therefore he must be right. Anyway, that's it. Like the video, subscribe to my channel, tell your friends about me. You all have a wonderful, delicious Sunday.